Hey guys, how's it going? I am here to bring you a video to teach you how to invest in index funds. Now, the purpose of this video is actually to encourage people to start building wealth, setting money aside on a regular basis. That way, whenever they go to retire, they would have a large lump sum to be able to rely back on, which a lot of people don't have these days. So this is not a get rich quick scheme. So you're not going to go 6 months later and be a millionaire after putting money into this. I'm not trying to sell anything. I'm just trying to help people that may or may not know how to use index funds and the importance of them. Now, the most important thing that you have is time for compounded growth. So those gains are going to continue to increase throughout your life. And the last couple years, whenever you're ready to start withdrawing on those, is when you'll see the massive gains. The markets are going to continue to go up without you. It doesn't matter. You just need to be along for the ride with everybody else. So if you don't have an investment account right now, you need to pause the video and make sure you go to a website and sign up. It's easy, it's free. It might take you 15 minutes. Any major company is fine. It's not a big deal. I've had experience with a couple different ones: Fidelity, TD Ameritrade, E-Trade. Any of those companies are fine. Go to their website. All right, so I do want to bring you an important statistic right now, so make sure you are paying attention. This is something that might actually blow your mind, so pay attention to this. Nearly 90% of all money managers fail to beat the S&P 500 index. Now, I want to repeat that real quick for you. Nearly 90% of all active mutual fund money managers fail to beat the market indexes. So if the professionals are unable to beat these indexes, why would an average Joe go out and try to pick a stock, whether it be Apple, Amazon, Facebook, Google? All those stocks are great. They're great companies. I'm not telling you not to invest in them, but over the long haul, picking the stocks that are going to beat the indexes, which is greater than 10% growth annualized per year, is almost impossible for the average person to do. So why make it hard? Why not just go and invest in these index funds, and it would be easy for you. You don't have to touch it. You don't have to do anything, and it's going to continue to grow. Now, I do have an active portfolio, a small percentage of my money that I do manage because I enjoy to do it. I've done well recently. I have beat the indexes, but over the long haul, that's going to be very, very difficult to continue that trend. The majority of my money is in these index funds, and you don't have to do anything, and they continue to go up. So regardless of what other people are trying to sell you in their videos or online, on their blogs, they're trying to tell you the latest secret. It's just not the easy way to do it, and most of the time you're going to end up with subpar gains. I'll try to break down some of the numbers and statistics and then give you a few different funds that are good funds. There are a lot of other options out there, but first I'm going to go through a basic definition of active versus passive invested funds. So an active fund is when a money manager is buying and selling different types of stocks regularly, and they're rebalancing the portfolio depending on what they think is going to do well and isn't going to do well. A passive fund is it just buys all the stocks. It buys all the good ones, it buys all the bad ones. And throughout history, they've seen that approximately about 10% returns annualized per year with the S&P 500 is about what you would expect with something like that. Now, that doesn't mean that that's going to be what the future brings. It could be a lot less than that. It could be 5%, 4%, 6%. Nobody really knows. But just using history as a guide, because that's the best that we have, that would be the expectation. Now, the most important thing to realize when you're picking these funds is to watch for the expense ratio. So what an expense ratio is it's how much money the investors are being charged for the fund that's being managed. So they charge more in active funds because they have to pay salaries and they have larger overhead because there's more people running the fund. Whereas when you have just a passive index fund, they can keep the costs lower. So with most active funds, it's somewhere around a 1% fee on all of your assets. With a passive fund or an index fund, generally it's 0.1% or lower than that, and depending on what you're invested in. So it doesn't seem like a lot initially, but over the lifetime of that fund, it could cost you hundreds of thousands of dollars. And as we've talked about earlier, over 90% of the fund managers aren't going to beat that. So you're paying more money for worse performance. So So why would you do that? It doesn't make any sense to anybody. So in the spirit of Jack Bogle, who is the founder of Vanguard funds, he's considered the father of the index fund. I'm going to only mention Vanguard funds in this video, but there are a ton of other companies that offer very similar products that are also very good. So you can pick and choose whatever your options are, what works best for you, but we're just going to cover Vanguard today just to keep it simple. So the first fund that I want to talk about is called VTI. It is a total stock market index fund, so it covers your large cap, your mid cap, and your small cap companies. Difference is the mid and small caps are generally less than 10 billion, where your large caps, your Apples, your Amazons, they can be upwards of trillions of dollars. So with VTI, its expense ratio is 0.03%. So it's almost nothing. They're hardly charging you anything to run this fund. And it's a very, very good fund. It's one of the most popular funds in the world today. So that's a great fund to put the great overwhelming majority of your money in. If you just want to set it there, not touch it, slowly put in money over time, and you can just watch it grow. It may go down. You may have periods of a year or two, 5 years. Nobody knows where it goes down. Just don't touch the money. Leave it in the fund, and it will go up over the long haul if history repeats itself. So a second fund is an alternative to that would be VOO is the symbol. It is Vanguard's S&P 500 fund. So it covers only the large cap companies. So it would consist of your Apples, Amazons, Facebook, Google, Tesla. All those companies are in this fund as well. It leaves out the smaller companies. It's very, very similar as far as the gains to VTI. So whichever one you would prefer in your own portfolio, either one. The next fund I want to talk about is the Russell 2000. So that is your mid and small cap companies, your less than 10 billion companies. It is VTWO. Now its expense ratio is 0.1, so it's a little bit higher than VOO and VTI, which are both the same 0.03%. And now this fund has actually beaten the S&P 500 funds over the course of the last year. That might not continue, but if you wanted to be invested in smaller companies, then this is another option for you that would be good. So the last fund that I wanted to talk about is the bond fund for Vanguard. So these are generally considered your safer funds. So as you slowly start to get more towards retirement, then you're going to want to transition more of your money to bonds. You're not going to make as much money off bonds over the long haul, but it's safer. So if you do have a market dip for 4 or 5 years, bonds don't tend to dip as low as the stock markets and equities. So as you're getting closer to retirement, you don't know when this market is going to drop and when it's going to spike. So you do want to have some of your money safer whenever you're able to take out some distributions at the end of your life. So a general rule of thumb would be if you're younger, you're in your 20s, you can put 90+% of your money in the VOO or VTI, and you don't really have to worry about it. As long as you don't touch it, it's going to continue to grow. It may go down some, it may go up some. If you continue to annualize, put money into the fund over the long haul, it's going to grow. The key is you just don't want to take money out if you start to panic or if it starts to go down, because then you're going to lose on the upside whenever things do rebound and the market recovers. So don't let emotion get into it, and don't try to time the markets. Just use the dollar cost averaging strategy, and it takes out all the guesswork. You shouldn't have to do that. Now, you may already be investing in some of these funds or similar funds to these through your 401k at work. So check and see what your money is actually in your 401k. You may be invested in actively managed funds, and I would encourage switching over to index funds as long as they're low cost. Make sure you do check that expense ratio and see what holdings are in these funds. If they're just like an S&P 500 fund, the majority of your money in your 401k should be in that, and then you can put a smaller portion in bonds, and that's all you need to do. You don't have to join the targeted aged funds. All that stuff is just packaged, and it's going to have higher costs to it than if you just invest in the passive indexes. So I would check your 401k. Also with that, I would check and see if you have a match. If you're not fully participating in a match with your employer, then you're definitely making a mistake, because that's free money that they're offering you. So it would be stupid not to use that. And then if you want to invest more money on top of what the match is, then you can invest up to, I believe it's like $19,000 or $20,000 in this year. It's going to continue to go up, but that would be a great strategy. I do want to put a disclaimer out that investments do have risk, so there is a chance you could lose money. However, if history does repeat itself, over the long haul, you will gain money and you will continue to grow wealth. With that, you do need to keep at least 6 months of an emergency fund before you would start investing anything, because you never know what's going to happen in your own life. You could lose a job, you could have a family member die, you could have a natural disaster, anything could happen in your life that you have no idea. Make sure you have at least 6 months of cash on hand immediately in a liquid account, because if the market tanks at the same time that you are having a bad event in your life, then you are going to be forced to withdraw money, and that's going to severely impact your return. So just make sure you're smart about it and keep enough money in a savings account or like a money market account that doesn't have those same risks. So if you do like this video, I'm going to try to continue to put more videos out. Please like, comment, subscribe to my channel. Hopefully once a week I'll have a new video just about personal finance and investing, and hopefully I can help some people out there. So please let me know what you think. If you have any topics that you wanted me to discuss, feel free to comment on those as well. Thank you.